First of all, it's a great pleasure to join everyone in the China PGM Market Summit. Actually, I only have very limited time for the presentation, so I'll go very briefly. So today I'm talking about the major cycle change behind the interest rate. So you are working in the precious metal industry. So the two major property of the platinum and palladium is first of all the financial property, and another is the property of commodities. So if you are to research the PGM, to look into its commercial demand, the industrial demand, to look at its demand and supply curve, well, today I want to approach from its financial property. So the order priority is the gold, silver, platinum, and palladium, and this order is also according to its financial, the strength of a financial property. So gold is at the top with the highest financial property. So I would always see gold as an association with the interest rate, and if and then the platinum and palladium, they are mostly determined by the demand and the supply. So the pricing is determined in this way. So what we should do is to analyze what is the anchor of the financial value of these precious metal, and this anchor is most of all the interest rate. In the past 40 years, if we look at the price of gold, you will see it's always on the upward trend.
Plus,
for 40 years, it already reached 2,000 plus. As for other types of commodities, given the fact that they themselves have varieties in terms of them being commodities, leading to different prices, we always use gold-silver ratio, platinum-palladium ratio, such ratios. So that's pretty much about the four types of precious metal: gold, silver, platinum, and palladium, and how I approach the analysis of them. Regarding interest rates over the past 4 decades, interest rate-wise, in fact, we have seen a very standard framework to examine interest rate. This framework is so much deeply ingrained in the minds of everyone. So whatever financial conference you may attend over the past decade and plus, or any industry forum related to platinum or palladium, whenever you hear people talking about macro landscape or monetary policy, in the past you might heard about discussions about US dollar. However, things have shifted. People start to become more professional. They started to see that interest rates sort of it's synonymous with Forex. So people started to have more and more discussions of interest rate. However, instead of focusing on interest rate, I decided to take it one step forward by looking at the spread, the interest spread. If you work on the commodities trading, you might be familiar with the curve, looking very much like either contango or backwardation. That's correct. In fact, if you see interest rate or money as a type of commodity, the forward and spot price forms the interest rate curve, which is very much aligned with the logic behind commodities curve. So over the past 4 decades, you might find the price of commodities which represent a premium of its cost, over its cost. Well, you might find the curve for most of the time is a contango shape. In other words, the short-term rate is lower than the longer-term rate. From the commodities perspective, we say that near-term or near-month price is lower than the price of the months further in the future. In other words, longer-term return is always higher than shorter-term return, a result of the contango of the interest rate curve. So you found that over the past 4 decades, most of the time, the curve stays below the zero or the red line. What does that mean? What kind of macro structure determines that interest rates across the globe has always remained a contango structure, meaning that shorter cost is lower, whereas that of longer term is higher. Well, In financial terms, that gives you arbitrage opportunities because you can short in the longer run, whereas you can long in the shorter run. And the more steep the contango curve is, the higher your return will be. Of course, if you consider margin, if you have enough margin. Let's just take an example. Say 1 is the return in the short run, and the biggest BP, the maximum BP is 350. What does that mean? It means that if the short-term return is 1%, then the longer-term return is 4.5%. That makes the interest spread being 3.5%. What does that mean? What can you do given that? What kind of arbitrage opportunities you borrow in the short run in order to capitalize on the 3.5% return? And the higher the spread, the larger the leverage you have. If the interest rate spread is 350 BP, you will maximize the leverage you can. In other words, the steeper the curve, the more leverage you will take on. What does that mean? The chart itself means that as early as 1982, you start to find a more interesting structure. Most of the time, you still have contango structure. In other words, for most of the time over the past 4 decades, finance surrounds this one keyword, borrowing. Borrow, keep borrowing, and keep borrowing more, because you find that the cost of money keeps getting down and the interest spread keeps widening. You can always maximize your leverage. Every time there is crisis, there's only one result you get from the crisis. Let's take a look at the chart. Every time the curve goes above the zero, it represents a crisis, 08, 09, and 2018. It seems that every time the curve goes above the red line, there were crises. However, whenever there are crises, there are opportunities. A lot of people fail to realize that during times of contraction, of course, some people may not survive, but still another group of people, they will thrive. What does that mean? As long as you survive this crisis, during the next round, they will do more leveraging and they will enjoy longer periods of contango structure with wider interest spread. What does that mean in absolute terms? Every time if you take a look at the arbitrage opportunities and leveraging results or returns by borrowing in the short run and short in the long run, let's take all these things together and to have one price. The price is gold price. Well, to put it simply, what is gold? That's mostly gold is the accumulation, is the inversion of accumulated debt and leverage. In other words, when there are huge amounts of low cost capital and a huge amount of leveraged borrowing, you will find that the gold prices will keep going up. Last year during November, I proposed this idea. I asked people, have you ever considered that the big logic over the past 4 decades has come to its end? Actually, before the meeting, I had discussion with someone. They told me that my statement might not be favored by a lot of people. I say I don't care, like it or not. That's how I think. Well, have you ever thought about this question? Why, starting from November last year, the logic that existed for more than 4 decades has undergone dramatic shift? Currently, we are in a backwardation structure in a way that the backwardation is very steep. What does the steep mean? We have never seen it once ever in the past 4 decades. You might need to go further back in time to more than 40 years ago in order to find such a deep backwardation curve. Let's take a look at the benchmark rate by the US Fed, 5.25, but 10-year yield on US Treasuries is only 3.7%. In contrast, why? In the past, you have never seen such wide spreads before. The reason is simple. If the spread is so wide, deleveraging will be so dramatic to the extent of crushing market crash. So starting from last year, people started emphasizing two factors. Factor one, assumption one, China will recover well from the pandemic. And the second is that the US market will crash with the US Fed increasing its rates. However, starting from the beginning of this year and for a long time in the future, you might find neither of the two assumptions will stand true or hold water. You will find that at 5.25 rate, the US economy remains resilient, and such resilience will exist for a long time. Have you ever thought about it? The logic has changed. In the past, the logic was that as long as the Fed raises interest rate, the economy went down, and when the economy goes down, the Fed is forced to keep to do rate hiking. And if now you say that because the Fed raises interest rate, the US economy is going to doom, and as a result, the Fed is going to be forced to bring down the rate, and as a result, because of that, the prices of gold, silver, platinum, and palladium will go up because of leveraging and additional leveraging. But let's take a deep dive into this chart and see why after 1980s the dollar interest rate has remained in such a structure. Well, to put it simply, over the past 4 decades, we have this general pattern by US Federal Reserve that they have never seen a real sense inflation. Powell has made it clear 3 elements to inflation: employment, salary, real estate, and commodities inflation. For over past 4 decades, we always find inflation driven by commodities or consumer goods. We have never seen inflation as a result of either employment or salary. But now what is happening in the United States, you find that inflation driven by consumer goods is rather moderate. Things have become more normal from the abnormal situation due to COVID or due to the Russian-Ukraine war. However, you will find that the US economy is really resilient, something that we have never seen over the past 4 decades. A lot of people attribute it to the COVID that we've seen over the past 3 decades, but that's very short-term missed idea. The curve started to change. The major shift started as early as 2008. So we started seeing the cracking point as early as 2008. Well, in summary, at the macro level, when globalization or when global division of labor and global collaboration was there, US featured moderate growth, low interest rate, low inflation, interest curve was always in a contango structure, and you can always borrow in US dollar, you can always increase your leverage, and you invest more than you trade or you do real trading in the real economy. But things have changed. When the global division of labor started to see sea change, you will find that the United States will enter into a period where capital goes back to the United States and they start to develop the real economy again. And the first stage will feature high inflation, high growth, and uncertain future of growth. However, if the United States will see technological breakthrough, it will have 3 highs: high growth, high inflation, and high interest rate. Actually, we've seen a situation in the precious metal market before. When the US has high inflation, high growth, and high interest rate, the price of precious metals remains like horizontal for a long period of time. We've seen such a situation before. Think about it. When the interest rate is high, returns on capital is good, and investment in the real economy as a result of technological breakthrough is good. How is it possible that we will see an inverted version of low interest rates? So when you see the capital markets has already reacted to what was expected, macro factors have already happened, including over the past decades, the world's landscape has changed. We have shifted from the beautiful globalization era to an anti or reverse globalization era, which will lead to the overall logic of investment in the financial market, as well as the investment framework and mechanism undergo sea change. Well, think about it. Back in the days, so whenever we talk about the past, we say that during Paul Volcker's leadership, there was very severe backwardation structure and a very severe stagflation situation. That might not be the case. Instead, we might see moderate interest rate backwardation. However, when you look at the chart, what is in your mind? 5.25 interest rate, however, long-term return to US Treasuries 3.7, 3.5%. Well, naturally, you will come to this conclusion. In the future, there might be two directions for you to pursue. Direction one is something that's favored by most people. What does that mean? At 5.25 will be too much for the United States. On one hand, TFP total factor productivity in the United States will not increase as expected. As a result, the Fed is forced to bring down the interest rate once again. However, there is a key point that's missed by a lot of people, either in China or in the United States. If you take a look at the capital market and if you take a look at all the equities investment products, when you talk about investment in equity, you always invest in equity in innovative technologies. In other words, when we are in a bottleneck period, we need technological breakthroughs to give us TFP or total factor productivity growth. And when that becomes reality, maybe the long-term return on capital will converge towards the short-term return. And when that becomes reality, high inflation, high growth, and high interest rate will remain there for a long period of time. And you have to think about the financial elements of precious metal using this framework by changing your mindset. This chart shows to you the price of gold. A lot of people did a lot of analysis of gold prices last year and this year. They say that the 10-year rate of the United States didn't go up and the Fed may not increase its rate anytime further. Why? Gold price kept increasing. People attribute it to restructuring global landscape, but take a look at the curve.
So when there is a deep backwardation, in the backwardation, the depth of backwardation will reflect people's expectation for the interest rate changes. So this is something we have never met in the past 40 years. It's unprecedented in the past 40 years. Well, I think my time is pretty tight, so that is pretty much I want to share with you. I'm reminding you that maybe we should consider the possibility that the paradigm have shifted. And while analyze the market for the PGM, you can also add your thinking about its fundamentals. Okay, I think this is all of my presentation. Thank you.